the definition of a dead dollar is a dollar that can no longer be exchanged for gold and silver at all. And you do that by buying gold, right? By raising the exchange rate between the dollar and gold. So we want to see it just keep going up and up and up and up, not because we want to have so many dollars in our portfolios that we can count and imagine how much we can buy with them, because in the end, the dollar isn't going to be worth anything, and you're going to be stuck with your ounces. And the ounces that you have will be able to buy the most during the end game, because the end game means the amount of liquidity, real liquidity in the system is so low that prices in terms of that liquidity become so high that you can buy enormous amounts with even silver, with even a few coins of silver. So that's what we're looking at. We're really looking. Silver is going to be the ultimate bell ring at the end of this. We're looking for a 15-to-1 ratio.
2024 has already seen prices surge above $30 per ounce, with $32 reached in May, which reduced the gold-to-silver price ratio to its lowest since December 2022, before moderately easing to roughly $28.50 per ounce by the beginning of August. Much of this support has been provided by the global silver supply deficit that persisted for the 3 years through 2023, in addition to the expanding supply deficit widely predicted for 2024. A financial journalist from the Endgame Investor, Rafi Farber, anticipates the collapse of the monetary system. Regarding wealth preservation, Farber predicts that silver will dramatically rise in value, potentially reaching a 15-to-1 ratio with gold. He mentions the dead dollar scenario, as the dollar will become obsolete when it can't be exchanged for gold or silver. Since 1971, the dollar has lost 98.6% of its value, with $35 now buying only 0.014 ounces of gold, as gold has surged to $2,500. With all the macroeconomic factors in play, Farber anticipates a significant pullback in gold prices, similar to March 2020, driven by a deflationary crash and banking crises. He explained that this drop would occur in dollar terms and expected the Federal Reserve's temporary response to lower gold prices. Gold prices gained on Thursday, fueled by strong expectations of a Federal Reserve rate cut in September, with investors focusing on U.S. inflation data for further insights on the potential size of the cut. If the inflation report is positive, it is another argument favoring cutting rates in September, which will push gold prices upwards, said Julia Kondoshko, CEO at European broker Mind Money. However, Farber advises against selling gold now, as timing the market is risky. He suggests holding on to gold, expecting the struggle to eventually undermine the dollar's value. Now we present the clips of Rafi Farber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think there's going to be one, March 2020 style pullback, and that's a pullback in dollar terms. It's not a pullback in commodity terms, which you saw in 2020 was, if you compare gold to commodities versus gold versus other commodities, the all-time high was in March 2020 when gold hit 1450, and that's when the mining stocks were really tanking, and people's portfolios, including my own that is heavy on mining stocks, really took a crazy beating, and we were having heart palpitations. And that could happen again because there's going to be one more deflationary crash when it could be when the reverse repos run out or shortly after that. And we're going to have banking crises all over. And then it's going to take the Fed some amount of time, not much time, to come in and say, okay, we'll print $6-7 trillion and then start doing it. But up to the time when they actually decide to do that or actually start doing it, gold is probably going to fall in dollar terms. And I'm not suggesting that anyone sell it now and then buy it at that dip and then trade it. You could, but to imagine that you'll be able to, and without panicking and time it just right, it's a little hubristic if you're going to try to do that. Maybe you could do it with a small amount of your capital, but I wouldn't try to do that and sell all your gold now and then buy it back at that point. It's much safer just to keep in mind that it's probably going to happen, because before hyperinflation is really a struggle between hyperdeflation and the central bank trying to exit that, which forces the liquidation of all the debt and the end of the banking system, which is going to happen in the hyperinflationary path instead. but they put it off in time with the inflationary strategy. The question really is the next printing round going to be the end and the hyperinflation, the end of the dollar? And I think it will be, because just globally we're on the precipice of a nuclear war, it seems. And Ukraine has now invaded Russia. They're invading a nuclear power. Putin could start dropping bombs whenever he wants. I don't know if he will, and I think he knows that if he does, the planet could be destroyed. So maybe he won't. But at some point, who knows what he's going to do? I mean, a nuclear power is being invaded by Ukraine now with American weapons. This doesn't seem safe. So in terms of what you said, the best thing to do is to buy gold and silver. Yes, it's not just about protecting your family and your wealth. That's an effect of it. It's a positive effect. But the point of doing that is to hasten the end and to get it coming as soon as possible. Because once the definition of a dead dollar is a dollar that can no longer be exchanged for gold and silver at all. And you do that by buying gold, right? By raising the exchange rate between the dollar and gold. So we want to see it just keep going up and up and up and up, not because we want to have so many dollars in our portfolios that we can count and imagine how much we can buy with them, because in the end, the dollar isn't going to be worth anything, and you're going to be stuck with your ounces. And the ounces that you have will be able to buy the most during the end game, because the end game means that the amount of liquidity, real liquidity in the system is so low that prices in terms of that liquidity become so high that you can buy enormous amounts with even silver, with even a few coins of silver. So that's what we're looking at. We're really looking. Silver is going to be the ultimate bell ring at the end of this. We're looking for a 15-to-1 ratio, which is the natural monetary ratio. And once that returns, that means that that derivatives of gold and silver no longer work at all, which is why the 15-to-1 ratio returns.
In his assessment, Rafi Farber clarifies that the shift to a fiat system didn't simply give governments power. The U.S. gained trust through its strong position after the 1930s and 1940s. He emphasizes that it's not about choosing between a gold standard or fiat, but rather about ending the inflationary practices and returning to a gold-backed system. The dollar has lost 87.5% of its value versus gold since 2000, using $300 as the benchmark for the gold price. Currency devaluation may be the most significant factor driving the price of gold. According to commodity market experts, gold prices today are on an uptrend due to weakness in the U.S. dollar and the buzz about the U.S. Fed rate cut. However, they said that gold investors are vigilant about the U.S. inflation print as U.S. initial jobless claims and GDP data are due today. Based on fundamentals, Rafi Farber discusses Nouriel Roubini's concept of activist treasury issuance, which he explains as injecting reserves into the economy without printing new money. He predicts the reverse repo facility could be drained by October, leading to a significant economic crash. Let's get back to the interview.
I just want to reframe or rephrase that a little bit. It's not that so much that we've gone onto a new system called fiat, and therefore that gives the government power. I mean, what happened was the U.S. was an enormous power, a trustworthy and good power until the 1930s and 40s. And with that trust, they were able to take the dollar, which is still gold and was much more gold back then, and tell everyone to use it. And once everyone started using it, because they had conquered Europe basically through World War II, and they'd conquered Russia also. Well, they still had a Cold War to fight, but basically they were much stronger. Then once you have everyone using the currency and you get them on that system, then you can start inflating. It's not like you take a vote and you ask your people, do you want to have a gold standard or a fiat system? And they're like, fiat. And then we're like, no, that's the wrong choice. That's not how it happens. Everything starts with gold and silver. And then when the government sees that it has the power to inflate, it will, right? And so it did. So it's not so much that we have to end this system as we have to end the inflationary part of the system and return to gold, which still is on the Fed's balance sheet. It's still there. It's only about 8% of the dollar now. But assuming there's gold in Fort Knox, which I assume there is, and I can't prove that, this is still a hangover from a gold dollar that's heavily inflated. I think Nouriel Roubini, they called him Dr. Doom. He's a mainstream Keynesian type economist, but sometimes he has some good takes, and he has decent instincts. And he was talking about activist treasury issuance. He gives it another three-letter acronym, ATI. That's okay. So he makes up another term, and now he can coin it and then sell his economist brand. So whatever, activist treasury issuance. He's talking about the massive issuance of treasury bills, short-term debt, and he's saying it's not fair that the treasury is issuing so much short-term debt because that is a de facto way to print money and transfer reserves into the monetary system by selling treasury bills, and then the government takes that money from the bank's reserves and then spends it into the system by funding wars. That's true. However, it's not that the Treasury can just print money. They need dollars to draw from. It's not like when the Treasury sells a bond, it's not like new dollars are coming out into the system unless the Fed buys them, indirectly, which they're not doing now. So those dollars that the Treasury bills are being bought with are being drawn from somewhere. It's not the Treasury printing the money, right? It's coming from the reverse repo facility, and those are all the dollars that were printed in 2020 and 2021 that couldn't make it into the banking system, but now they are. It seems that by October, I'm hoping by October, it could be delayed because it's been delayed it's excruciating that they still exist, these things. There's about 350 billion of them left now. But from the Treasury's schedule of T-bill sales and auctions, hopefully they will be drained by October. And once they are, then there's no more new money coming in to the system. There is sort of QE going on, but it's like latent, delayed, leftover QE. So it's not official, but it's happening. And that's why the stock market is at an all-time high, and it looks like the economy is not crashing. That's the reason. So what happens when these things finally run out? Well, then the money supply is going to really start to fall fast. And then you're going to see the major, Keynesian style crash that we all think of when we think of depression. And the response to that is going to be the final printing run. In my opinion, the final one. You could argue maybe there's going to be another one, but we're going to have to wait another few years. But you know what? We're running out of time.
With the potential depletion of financial resources and a likely shift in market dynamics, currency values and precious metals could be substantially impacted. Silver requires exceptional conditions like rising inflation or an extreme shortage to rise to $100, which might not be its endpoint once it clears all-time highs. How will the evolving economic conditions impact your investment strategies in precious metals? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.